Hello, everyone, and a very good evening to all. I hope I'm audible. And welcome to a special session on yield tails and market turns. What's driving the debt story? So the last few months have been anything but dull for the fixed income markets. Globally, we have seen the US Federal Reserve deliver its second rate cut of 2025 and announce an end to quantitative tightening, all while the US economy grapples with the government shutdown and rising fiscal strain. Closer at home, the Reserve Bank of India or RBI has maintained a policy, sort of status quo as of now, but turned more comfortable on inflation even as yields stay volatile amid shifting global cues. So, the question that arises is that what do these turns in the policy and yields dynamic really mean for investors? To decode this evolving landscape, today we have with us our Chief Investment Officer for Fixed Income, Mr. Mahendra Jaju, who will be helping us, make sense of all the macro narrative, the positioning that's going on, and the opportunities ahead. So I welcome you, Mr. Jaju.
Thank you.
So without further ado, let's dive right into it. So for the ease of understanding of our viewers, this session is, divided into a question and answer sort of a theme, wherein I'll be asking, questions from Mr. Jaju that, on what's there, what is there going on in the US market, Indian economy, etc., so on and so forth. So the topics for discussion for us today would be, the US Fed's decision that happened on the 30th of October and the US macroeconomy. In that backdrop, the Indian economy and of course the debt markets, and ultimately, as investors, what's the investment case for you all? So let's dive right into the first question. So, sir, the US Feds, we just saw 25 basis points rate cut on 30th of October Indian Standard Time. And there was also an added pause to the, balance sheet runoff with which, marked a notable policy pivot among, whatever shutdown is going on within the US government. So how do you interpret this move? Is it a durable easing cycle or a temporary adjustment to cushion, the near-term growth outlook or, the growth risk? So what's your base case for the US yields also as we go into the year 2026?
So my base case is for Fed to cut rates further and inject more liquidity. So we have seen in the last policy that they have indicated they will stop the quantitative tightening now. And it's not very far that they will have to start quantitative easing. However, the guidance has been very, very confusing and sort of hawkish, as most analysts have said. So Fed has cut rates, they have stopped quantitative tightening, but they have still said that they are not sure whether the next policy they will be able to cut rates or not. So I think that is keeping the market on a little bit of an edge. There is no clarity and certainty of the guidance. We know that because of the government shutdown, there is a blocking of the data release, so people are also having to act in the absence of more relevant and recent information. So while the Fed has cut rate, it has not percolated down to the longer end of the yield curve. As we have seen that in the last 1 week alone, the 10-year yield in US has gone up from close to 4% to 4.15 now. So on a net basis, since the last rate cut, the yields have gone up by close to 20 basis points. So it would seem to me that the market is worried about the lack of clarity and decisiveness on part of the Fed. The second factor which is bothering the participants is the possibility of inflation spike because of the tariff related issues and with a lag effect of those tariffs onto the consumer prices. But most importantly, about the need to refinance a large amount of maturing debt. So numbers which have been floating around are something like $8 trillion and so on. So globally, we have seen the trend of long-term yields going up because of the huge financing requirement, whether it is UK, whether it is Japan, whether it is France, and for that matter, US. So in spite of sustained rate cuts in Europe, the European long-term rates have not come down. There is a global concern on the large amount of debts which is maturing and the ongoing fiscal deficit. So in that context, the compounding of the concern has been done because of the lack of clarity from Fed. So my sense is that while we will see further rate cuts from the central banks, whether it is Fed or the Reserve Bank or most of the other, parallel central banks, except of course Japan, which is in a counter-cyclical tightening situation because they have had such a overly, easy monetary supply for so many years. So while the central banks will cut rates, I don't see too much happening at the longer end of the curve. I don't think that long-term yields are, waiting to age substantially for now.
Okay. Sure. So now that we got a little sense of the yields, what where you are seeing in the baseline scenario. So the shutdown related gaps that it has created in releases, in the releases of data points, which is both useful for the US Fed decision making as also for other policy makers. The we are seeing that this headline data is becoming increasingly noisy, and this is also impacting the yield curve dynamics. It's also changing that. So what global indicators are you watching most closely right now, say in terms of in yields, in the spreads, commodity prices, or forex reserves, that could signal the next major directional move, especially in the bond markets. Especially why? Because we do not have certain data that was supposed to be coming out. So what are you watching at, to make the sense of the baseline that you just communicated?
So if you look at our discussion, what we are highlighting as the most important and most dominant factor affecting the bond market sentiment, that is the prospect of large supplies and prospects of not enough demand, because there is a lot of debt which is maturing. There is a high degree of fiscal deficit which the most governments are still running. Therefore, the supplies are going to be higher, and because of different factors, including the uncertainty that has been caused because of the tariff tantrum and people wanting to move out of the US to some extent, there is a concern as to where that supply will find a demand. And therefore, the most important factor that I'm watching obviously is if and when the Fed will start the quantitative easing again. Because if the Fed starts quantitative easing, which means that if it starts to buy bonds again, that will be the most effective counter against the concern on the supplies. And if you look at the Indian markets also, in the last 1 week, there is a new narrative which is floating around in the trader circle that Reserve Bank might start a fresh round of open market operations purchases. So that has given some life to our bond market. So our 10-year yield has now come close to 6.5. So I think the most important factor that we should watch for is whether the central banks start the quantitative easing again. As far as the other important factors are concerned, obviously you watch all the time about the inflation trend, about the fiscal deficit trend. But what we have seen in the last, a few years, especially post-COVID global world, that the markets seem to be, indifferent to most developments. We have seen that everyone in the analyst community is expecting US economy to slow down for the last 2 years, but the economy has continued to roll on with a reasonable strength. Post the tariff tantrum in the last 6 months, every analyst was expecting the fiscal deficit in US to pick up, but it has not, because there has been some support from the tariff revenues, of course, but even otherwise, there have been savings on the war-related expenses, for example, contribution to Ukraine, etc. So on a net basis, neither the inflation nor the fiscal deficit have picked up in any meaningful way. But the frustrating fact is that they don't seem to come down as well. For example, inflation is stuck in that range. So therefore, market is apprehensive. Every morning you wake up and you're worried about yields going up, and then there is a concern on supply. So I think while we watch the other factors, what I was saying is that markets have somehow been able to overcome those factors and has been very resilient. Therefore, the important factor to watch now is whether or not the Fed starts quantitative easing, because if they do, then the rest of the central banks will follow. The emerging market central banks will get a little bit of breathing space. So to my mind, in the next 3 months, the single most important factor that we should watch is how the fear of supply will be addressed. And the most obvious counter to that, as I said, will be quantitative easing, and that's what therefore is what I'm watching for.
Sure. Sure. So quantitative easing and the stance of the US Fed going forward would be something that, clears a lot of, ambiguity in the market or the uncertainty in the market. So, now coming on India and, domestically.
Just to add to that,
Yeah.
so what we should also clarify once again is that therefore, if there is a rate cut, that is no longer sufficient for the long-term rates to come down. The short-term rates coming down is possible with the help of the rate cuts and liquidity injection, but the long end of the curve is right now demanding a very different term premium because of the supply factor. So therefore, at this point, I think our audience should clearly understand that just a rate cut is not enough for the long-term rates to come down.
Sure, sure. So, other than rate cut, also there has to be certain factors, to be looked at, especially when, the rate cut and the yield scenario is looking at. So, coming at home, on the domestic part, the RBI has currently paused at, 5.5% the repo rate. And, while on the inflation forecast, they have softened and they have also communicated that we are a little comfortable on the inflation side. However, given the global spillovers and, the domestic growth and inflation trade-off. What is your reading, on the RBI's policy path through, 2026, while in 2025 it has been remaining, a little similar commentary, data-driven commentaries we have been seeing from RBI. But, through 2026, how do you look at the timing and the magnitude of potential easing? And, also at the same time, what are the main risks or factors that could derail it, or that could say add to a very contrast view or stance by the RBI?
So I think very clearly today there is a very, very compelling case for the Reserve Bank to cut rates further. I mean, we are at 1.5% inflation now. Even if there was a revision upwards in inflation because of the base effect or because of the reversal in the food articles, the inflation can go back to headline of maybe 4 to 4.5%, which still leaves enough room for the Reserve Bank to cut rates. The government has indicated a very strong, fiscal situation, so strong that the government could find space to, cut the GST rates very, very materially. And we have seen in the month of October that in spite of such a significant revision downwards in the GST rates, the GST collection has actually still gone up by 4% at about 1.96 lakh crores in October. So government's fiscal situation is absolutely strong. We have just seen a rating upgrade for India, and the growth momentum is strong and building up. So we had a 7.8% growth in the last quarter. That was far beyond any analyst's expectation, and that if you extend that momentum into the current quarter, you can comfortably expect a rate, GDP growth rate of somewhere between 6.5 to 7%. So therefore, both on the growth and on the inflation front, and then on the fiscal situation, RBI is in a very, very comfortable situation. And now we also have had two successive rate cuts by Fed after a gap of close to 1 year. So therefore, the global environment has also become reasonably relaxed. Therefore, there is every reason for the Reserve Bank to cut rates further. We may not possibly need to wait till 2026. Might be in December we'll see a rate cut. But then, as I said in my earlier response, that a rate cut by RBI may not necessarily result in the long-term rates coming down. We have seen what happened after the June policy, that while RBI delivered a jumbo rate cut, upfronting the front loading, as they say, the scope that the Reserve Bank had at that point, the long-term rate have since actually gone up and meaningfully gone up. So again, in India, you have an issue with the demand because there are a lot of pension funds which have been allowed to increase their allocation to equity, and therefore they have not been buying long-term bonds. So there has been subdued demand from there. the life insurance or insurance sector in general has not grown at the solid pace that it was growing in the previous years, and that has again led to subdued demand. Rates had come down, so people were not buying just more than what they minimum needed to maintain their ALM, and this is based on our interaction with a lot of these insurance companies. So there was a subdued demand, but most importantly, the Reserve Bank was comfortable with the domestic scenario, but they were a little apprehensive about the global environment. So in global environment, as I discussed, the tendency for the long-term rates is to go up because of the supply concerns, and therefore the Reserve Bank also possibly did not want the long-term rates in India to come down crashing, and remain in sync with the global trend, and more so because we are perhaps the only large country to still have a very significant misalignment with US on the tariff issue, and that can have a significant impact. For example, today I was watching the management commentary from a couple of large chemical companies, and they were saying that look, there is a meaningful impact on our exports to US. So on the ground, it has started to have effect, and that I think the Reserve Bank is completely cognizant of. So therefore, if you look at June to October, the Reserve Bank has been very focused on transmission of the rate cut into the broader economy at the shorter end. They've injected liquidity, but they have not really done anything about the long end of the curve because there is still a lot of uncertainty at the global front. Therefore, if you bifurcate the current monetary policy space into domestic and foreign or the global environment, then you will see that while the domestic environment calls is shouting, begging for a rate cut, whereas the global environment does not allow a lot of easing of the long-term rates. Therefore, I think we expect the Reserve Bank to cut rates. I expect the Reserve Bank to cut rates by about 50 basis points up to March 2026. But I don't expect that again to have a very strong impact at the long end of the curve. So you can expect the curve to steepen from the that perspective. So what we call generally the bear steepening of the yield curve, as in our technical terms.
Right. Right, sure. So now from, the central bank stance to, more on the market functioning side. So, market functioning, this has become a bigger driver of yield movements. So how are liquidity conditions, across the bonds, says, for example, the state government or the SDL issuances, how are bank balance sheet positioned, and the influence of G-Sec and corporate bond, on the yields, how is that looking at this point in time, and which of these structural factors concern you or make you hopeful the most from a market stability point of view or an opportunity point of view?
So again, I think that's a very good question because a lot of times or most times in the webinars, people just ask the you know main questions about the central government bonds, etc. But I think you have touched upon the demand from the banks for the funds and from the state government. So overall liquidity condition, I think the Reserve Bank has done a great job in terms of injecting liquidity right from the beginning of 2025. They've been injecting liquidity first through open market operations, then by way of CRR cuts, and so on. They also did the FX swaps, etc. But what we have seen is that notwithstanding the liquidity injection of such a magnitude, in the last 1 month, there were days when our banking system liquidity was negative, and the banks were borrowing from the Reserve Bank by way of repos. So I think the FX has possibly drained a lot of liquidity from the system. The government cash balances continue to remain very large, which has withheld that liquidity from being accessible to the banking system or the market in general. So you will expect the government to spend at the beginning of this month, so you will expect liquidity to improve in the next few days. But again, you will have the GST tax collection, etc. So what we have seen over the last 6 months is that the government cash balances have tend to remain on the higher side. So I think we are expecting the liquidity to be on the neutral side. We have seen a huge supply of CD from the banks. Supply doesn't seem to stop. And then this last 3 months in particular, we have seen a huge supply from the corporate sector. So large uh, business groups, for example, Reliance, Bharti Telecom, they have all mobilized close to 25,000 crores from the market on an incremental basis. The public sector companies continue to be perennial borrower. There was a time in 2023, early 24, where there was no supply from these people. So I think there is good supply, and as we discussed earlier, not enough demand except for the mutual funds who are getting money mostly in the short-term money market category. So therefore, I think overall liquidity situation is balanced. We have a decent marginal liquidity surplus in the system, but there is enough supply. So again, here the bond market has to be supported by fresh open market operations by the Reserve Bank.
Right.
And for that will maybe trigger the bond yields down. So there has been a lot of rumor or talk in the market that the Reserve Bank has invited the bond dealers and the banks for a meeting on how to look at these bond yields. So in the last Friday auction, RBI did not accept any bids in one of the securities. So I think after June, this is the first time that we have seen a bit of a supportive action or indication from the central bank. So hopefully that helps the bond market. I think it will help the bond market will stabilize, maybe come down by 10 basis points. But again, at a structural level, I remain a little bit, reserved on the longer end of the curve.
Sure. So, now coming, how does all of this gets into, the product recommendation or, the opportunity for investors? So, against this backdrop of all you said, the disinflationary signals on the global side, but, the episodic volatility, how should investors be balancing their debt portfolios? Should it be duration versus a credit part today? Or, do you prefer to add duration for now, adopt a Babel sort of an approach, or focus on a selective roll down? So, there are three choices probably that I am asking you, or, your answer is something to altogether different also, that add duration, adopt a barbell sort of an approach, where one side there's duration, one side there is short term side of the yield curve, or, be selective on the roll down part of the bonds. So what's your take on this?
Now, again, I think you have very carefully selected the three options, which between them always are valid, at least one of them. Thank you for that. I think it makes easy for the investors to understand the context. And I think everyone can understand from the way the discussion have been so far that the first option, that is to add duration now, is not something that I prefer at this point in time. But yes, there is a bit of value at the longer end of the curve. Long-term rates have reversed very sharply after the June policy. Most of the bonds in the 30-year plus category are still trading at comfortably above 7%. So there's a good carry. So barbell is a good strategy right now, but with a little bit modification. In a barbell, typically you have equal weight at both ends of the curve. I will say that the ratio should be a little bit skewed towards the shorter end. So I will say 75 to 80% at the left hand side of the dumbbell and maybe 20 to 25% at the long end. So that's one strategy which will work. The practical strategy or my preferred strategy at this point is a roll down strategy, and especially in the 1 to 3 year segment, because I think the money market curve is very steep. So one can look at the far end of the money market curve and then look at the 1 to 3 year for some capital gains from the corporate bond segment. So if you summarize this, and then I think possibly your next question will be which product in the mutual fund segment.
Right.
I'll wait for that question. I don't know.
Right, right. So that is what I was going to, that, of course, today in the webinar also we're joined by, probably both retail set of investors and institutional set of investors. So, what product baskets do you think would offer the best risk adjusted entry, or, best risk adjusted performance over the next 6 to 12 months, or, even on a longer period horizon for two set of investors, because debt markets are known for also institutional investors as well as retail investors.
So I think the market remains the same whether the investor is an institutional investor or a retail investor. The difference is the ability of the institutional investors to actively rebalance its portfolio in line with the evolving
Right.
situation. Whereas at a practical level, we haven't seen retail investor being able to do that. So with that rider only, I think we have one of the best product now in our industry, which is that income plus arbitrage FOF, because there were two, regions we saw a bit of withdrawal by the retail investors from the debt funds. One was the withdrawal of the tax exemption. So the income plus arbitrage FOF brings back the advantage of the long-term capital gain taxation. So if anyone is investing in the income plus arbitrage FOF category, then he will be taxed at the long-term rates if he is holding it for more than 2 years. So that's, I think, a big, big plus factor for the debt investors into debt mutual funds, because this is now the only pure debt product anywhere in the country which gives a long-term tax advantage, apart from obviously directly holding the listed bonds. The second is that the environment has been very volatile. Things have been changing very fast. There could be tactical opportunities in the next 3 months if the Fed starts quantitative easing, and then Reserve Bank also becomes a little more accommodative. But then, in our view, that may not last for very long because of the sustained supply. So, the income plus arbitrage FOF category also brings back the dynamic allocation. So, fund manager, depending on the market environment, can rebalance the exposure to different segments. And to that extent, I think income plus arbitrage FOF category is the most suited, in my personal view, for the retail investor, because it brings in tax efficiency and it brings in inbuilt dynamic allocation. And because retail investors can remain invested for 2 years, for institutional investors, sometimes it is not allowing that kind of holding period. But for those who can, they should again look at income plus arbitrage. Then you look at that barbell strategy, modified barbell strategy, as we called it. So there people can invest 75 to 80% in the low duration money market category, and then 25% in the long duration category. Because if the duration performs, then it is no brainer to be then in the long duration category. If it doesn't perform, then obviously it will have some impact, but overall impact will be same of spreading yourself across the curve. The advantage of this barbell is that even if the long end, for example, does not do well in terms of the capital gains, because they'll go up or something, the carry of 7% will continue. So people can take it as a long-term FMP 7% carry, not bother about capital erosion, and then in the next interest rate cycle, let's say 2 year, 3 year, the yields will come back. So they will earn at least 7% if they invest in the long duration. So therefore, I will say that right now, one option is invest in the income plus arbitrage FOF. The other option is to invest in low duration and money market combination, and for say 75 to 80% and 20 to 25% in long duration.
Sure. So, for retail investors, it's income plus arbitrage, which is clearly offering a tax efficiency and a play into the shorter end of the yield curve. And for institutional, they can, of course, look at the shorter end of the yield curve through a barbelled approach, which is tilted a little more towards the short end of the curve, like money market funds, short duration, and, little on the duration side if they are able to position themselves there. So, with this, viewers, the dice is open to questions. You can drop in your questions, in the Q&A section or in the chat box, and we'll be happy to take it. So we'll start right into it. So first question is by Mr. Bhavesh Mehta. It is the question is that, is it a good time to look at or invest in government securities at this point in time?
No, I think we have already discussed this, that at this point, I will not advise overweight into the long duration bonds. Government securities are always welcome. They are the safest income. My personal preference right now will be to not very massively overweight on the duration for the reasons I explained and what I believe in. Right now, one should look at the, for example, 9 to 12 month, the AAA Financial Services Index, low duration fund, and the money market fund. Not
No.
the right maybe for heavy weight on the long duration category.
Right. So, the follow-up question by Mr. Prakash Tharwani is on the similar lines actually, that, why the gilt funds are not performing in the fixed income space.
Well, because the yields have gone up, and Tanya, we had highlighted the change in the stance in June policy itself, that it is time to switch from duration strategy to accrual strategy, because for the last 2 years the bond funds had done very well. They had given 10% plus return, but in the June policy there was a clear indication from the RBI that while the rates are being cut, it would have more impact at the shorter end of yield curve. So I think we are expecting that the returns in the long duration category will remain subdued even going forward. So they should switch to a modified barbell strategy, or switch to low duration category if they want to not have the same experience again.
Sure. So another question we have is that, how much room does the RBI really have to cut without triggering the capital outflows or, the yield or triggering the yield volatility?
I think right now Reserve Bank clearly has room to cut by 50 basis points more without disrupting the markets in any way.
Okay, sure. So another question we have is that, could India's easing cycle diverge meaningfully from the global peers, given the relative macro stability that we have in India?
So we already have seen that in the last 2 years, because in the last few years, the Reserve Bank has been giving a lot of weightage to the domestic factors, and been a little bit more adventurous and aggressive than it had been in the past. So this time we have clearly seen that in the months from uh, you know uh, December 2024 to March 2025 to maybe April, May 2025, RBI has been extremely accommodative. They have been injecting liquidity left, right, center by way of open market operations. They have cut rates by a cumulative of 100 basis points during this time when the Fed was on hold and Fed was not guiding for rate cut. So our policy can be meaningfully divergent from the uh, global policy, because it's not for India. I think generally for the emerging markets versus the developed market, the past correlation is not going to hold, because emerging markets have become very strong. So you look at India today. Uh, Earlier, we used to have the reverse challenge that our inflation is high, global inflation is low. Today, we have a reverse challenge that our inflation is at 1.5%, US inflation is at 3%. In our monetary policy press conference, people ask Reserve Bank, why are you not cutting rate if the inflation has come down so much? In the Fed policy, press conference, people ask, how can you cut rates if your inflation projections are still not coming down? So what I'm trying to say is that our economy, or the emerging markets economy in general, have become far stronger and self-dependent, primarily because all of them have strong reserves. All of them have, economy which is dependent to a large extent on the domestic consumption story, and all of them have a reasonable inflation. So therefore, I think it can happen. But I think Reserve Bank is a very, very smart, very, very knowledgeable regulator. They know what is the point up to which they can press, and that's what we have seen in the last 3 months, and which is what I've been trying to explain, that the Reserve Bank has allowed the short-term rates to come down, but they have not been too worried about the long-term rates going up, which is in line with the global trend. So I think as long as our regulators are so proactive and so understanding, I think that can work.
Sure, the resetting has been seen more on the short end of the yield curve. So another question by Mr. Sarvesh that given the current elevated yields in the 3 to 5 year bucket and the equity markets hovering near lifetime highs, is this an opportune moment to selectively roll down into high quality debt, capturing yield plus potential capital gains while reducing valuation on the equity side, by reducing valuation risk on the equity side?
So I'm not sure if I'm the correct person to answer this because I'm a portfolio manager for that. I'm not a wealth advisor or asset allocator. So somebody who deals with asset allocation can give that answer. At a very general level, I think asset allocation is something that is important. So if people have a strong view, they can take a call, but I would not advise anybody to deviate significantly from the basic asset allocation because we don't know how long the markets can remain irrational before we lose our patience. So I think
So
it is not advisable to take liberty with the asset allocation.
sure, because asset allocation is also a function of, an individual's risk appetite, their investment goals, etc., and their investment horizon, of course. So,
And, and,
probably
and we have any number of studies, empirical,
right,
which has said that in a typical investor's portfolio, contribution from the returns, the maximum weightage is from asset allocation and not from worrying about valuation.
individual asset
I
class, of
think
course.
the conventional wisdom will say to not tamper with the asset allocation in a meaningful way.
Sure. So, probably one of the last question that, is the credit risk still adequately priced in the 3 to 5 year corporate bond space, or are the spreads too tight?
Uh, It's reasonable. I won't say it is too tight, but I will not say it is very attractive also. There was a time in 2023 where the credit spreads were very, very attractive. They were trading at above their long-term average. Now they are trading at their historical average. So in my view, it is neither attractive nor very richly valued. It's a reasonable one. So if the RBI remains so accommodative, if they cut rates further, if the liquidity remains good, then there is a scope for these spreads to narrow. So, which is why low duration or to some extent short duration because that these are the products which can take advantage of.
Sure. So, thank you so much, sir, for those deep insights. And it's clear that, the debt story right now is less about, chasing the yields and more about navigating a turning cycle, which much more discipline that's required. So, any closing remarks that you have for our viewers?
I think the most important part for an investor is to remain invested. And we have seen historically that debt mutual funds have always perform better than other options. They give you the maximum range of the products. So there is something for everyone. There is a lot of, I think, disappointment in the industry for last couple of years after the tax exemption was withdrawn. But even the basic study will suggest that even without the tax exemption, that funds are still better than the corresponding competing products, especially the bank fixed deposits. And therefore, today also most of the banks are giving 2.5-3% on the savings account balances, where the liquid funds are giving 5.5%. So it's a no-brainer, except for lack of conviction or except for laziness. There is no reason for people to not shift from savings account to the liquid funds to start with. So therefore, I think it is important to look at the things as they are, not be too concerned about the volatility in the debt funds because there is no free lunch. If you're going to get high return, there is going to be some pain that you to accept. So my request for will be to remain invested without worrying about the market volatility too much. Choose your products wisely, and that should be a good experience for every investor.
Sure, sir. Thank you so much. And investors, those of you looking for a tax efficient manner probably could look at, going through the income plus arbitrage active FOF category that provides you tax efficiency at the long term capital gains levels if one stays invested for, 24 months and above. So we keep on doing such webinars and such sessions, and we also keep on coming up with newer notes. So do visit our social media handles or website. So thank you so much, Mr. Jaju, and have a nice day for the day.